Corning Incorporated, ticker GLW on the NYSE, a company that has been making specialty glass since 1851, from Thomas Edison's light bulb envelopes to iPhone screens to AI data center fiber optics.
Founded in 1851 in Somerville, Massachusetts, headquartered in Corning, New York, 62,000 employees. The fiber optic cable that carries the modern internet was invented here in 1970.
Amory Houghton established Corning Glass Works in 1851. The first great breakthrough came in 1879. Corning manufactured the glass envelopes for Thomas Edison's first commercial incandescent bulbs.
In 1970, Corning scientists invented the first single-mode optical fiber capable of carrying telephone signals at scale. That invention became the nervous system of the global telecommunications network.
The telecom bubble drove Corning stock to $113 in 1999 as fiber demand surged. The subsequent bust crashed the stock to $2. Corning survived because its specialty glass manufacturing was irreplaceable, not replaceable.
In 2012, Apple specified Gorilla Glass across the entire iPhone lineup, cementing Corning as a designed-in supplier to the world's most valuable consumer product. Samsung and virtually every Android OEM followed.
CEO Wendell Weeks launched the Springboard Plan in 2016, a strategic pivot to 5 core growth platforms, including optical fiber, automotive glass, and life sciences. The plan identified AI infrastructure as a decade-long growth vector.
In 2024, Corning signed a $6 billion deal with Meta, the largest single contract in company history, to supply optical fiber for Meta's AI data center connectivity buildout.
Corning generated $12.6 billion in fiscal 2024 revenue. Optical Communications is the largest segment at 32%, $4.03 billion, growing 34% year over year as AI data center buildout accelerated.
Display Technologies contributes 30%. Specialty Materials, which includes Gorilla Glass, adds 17%. Environmental Technologies and Life Sciences round out the portfolio at 14% and 7%, respectively.
Core operating margin reached 18.2% in 2024, up 2.1 percentage points year over year. Core EPS grew 25% as Optical Communications demand accelerated faster than Corning's production capacity additions.
Every AI GPU cluster requires petabits per second of internal fiber connectivity. Corning's optical fiber is specified into hyperscaler and co-location data center designs with lead times extending 18 months or more.
Corning has raised its dividend for 14 consecutive years. Starting at 52 cents annually in 2015, the dividend grew to $1.02 annually by 2024, backed by a 174-year track record of manufacturing irreplaceable materials.
The total annual payout reached $960 million in 2024. Net debt to EBITDA stands at 2.8 times, manageable leverage for a business with 130-plus manufacturing facilities generating durable cash flow.
Corning leads the competitive radar on fiber optic leadership at 95 and AI infrastructure exposure at 92. The combination of display glass, specialty materials, and fiber, each with different demand cycles, is a diversification no single segment peer can match.
Amphenol competes in connectivity components and scores well on manufacturing moat and innovation pipeline. Ciena competes in optical networking, but lacks Corning's materials science depth and display glass franchise.
Corning operates 130-plus manufacturing facilities across 35 countries with over 9,000 active patents. Its 174-year specialty glass manufacturing moat rests on precision forming, fusion draw, and chemical strengthening techniques no new entrant can shortcut.
Wendell Weeks has been chairman and CEO since 2005. He earned a BA from Lehigh and an MBA from Harvard Business School. He led the optical fiber division through the telecom bubble and bust before rebuilding Corning into a multi-platform specialty materials company.
The Gorilla Glass franchise creates deep supply chain switching costs. Apple, Samsung, and virtually every Android OEM have consistently chosen to keep Corning designed in. Requalification costs make displacement economically irrational across device generations.
Corning has been inventing glass that the world didn't know it needed since 1851, from Edison's light bulbs to iPhone screens to the fiber optic cables that carry every piece of data you've ever sent, and the $6 billion Meta deal just made Corning the most important infrastructure company in the AI era that most investors have never thought about.
The Optical Communications segment growing 34% in a year is the story. Fiber demand from AI hyperscaler buildout is creating a supply-constraint environment where Corning can price above its historical norms, and the backlog visibility is the clearest it's been since the telecom bubble. But this time the demand is structural, not speculative. Corning Incorporated, ticker GLW, reported Q1 2026 revenue of $4.2 billion, up 22% year-over-year. The 174-year-old glassmaker is in the middle of the most significant demand surge in its history, driven by AI data center fiber optic buildout.
Adjusted EPS, 57 cents versus 52-cent estimate, a 9.6% beat. Revenue, $4.2 billion beat the $4.05 billion estimate. Optical Communications revenue, $1.85 billion, up 41% year-over-year.
Corning makes the fiber optic cable, the glass substrates, the optical connectors, and the splicing hardware that moves data through every major data center on Earth. When Google, Microsoft, Amazon, and Meta build AI infrastructure, Corning is the picks and shovels play.
The stock is at $169, up 340% from the 52-week low of $38.56. Has the fiber optic cycle run its course, or is the AI buildout just beginning? Let's build the case.
3 changes define Q1. First, optical connectivity record orders. Hyperscalers, Google, Meta, Microsoft, Amazon, accelerated fiber optic procurement in Q1 2026 as they compete to build next-generation AI data center campuses. Corning's order backlog extended to 18 months.
Second change, display glass recovery. After 5 consecutive quarters of price declines, display glass pricing stabilized in Q1 2026 as Korean and Taiwanese panel manufacturers began capacity expansions for OLED and premium LCD display upgrades.
Third change, Gorilla Glass AI device cycle. Corning's Gorilla Glass ceramic is the default substrate for premium AI-capable smartphones, including Samsung Galaxy S series and Apple iPhone. The AI phone upgrade cycle drove a 12% year-over-year increase in specialty materials revenue.
The Springboard Plan. Corning's multi-year restructuring program targets $400 million in annual cost savings by 2026. In Q1, they completed closure of 3 display glass facilities and consolidated optical manufacturing into larger, more efficient plants.
Supply chain investment. Corning broke ground on a new $1.5 billion optical fiber manufacturing facility in North Carolina in Q1 2026 to serve domestic demand as U.S. hyperscalers prefer domestic supply chains for AI infrastructure, expected online late 2027.
Gross margin recovery. Q1 2026, gross margin reached 38%, up from 35% in Q1 2025. Fixed cost leverage on optical fiber volume plus restructuring savings drove the margin expansion. Management guided gross margin to 40% by year-end.
Life sciences acceleration. Pharmaceutical glass demand grew 8% as biotech and GLP-1 drug manufacturers expanded vial production capacity for obesity medication and gene therapy storage. Corning is the largest manufacturer of pharmaceutical glass packaging globally.
Q1 2026 total revenue, $4.2 billion, up 22% from $3.45 billion in Q1 2025. Revenue beat the $4.05 billion consensus estimate by $150 million, a 3.7% beat.
Optical Communications, $1.85 billion, the dominant segment at 44% of total revenue. This segment was $1.32 billion in Q1 2025, 41% growth. The AI data center fiber surge is real, and the order book extends through 2027.
Display Technologies, $1.02 billion, 24% of revenue. Display glass pricing stabilized in Q1 2026 after 5 quarters of declines. Volume was up 6% year-over-year as panel maker inventory destocking completed.
Specialty materials, $520 million, Gorilla Glass and semiconductor glass substrates. Specialty grew 12% year-over-year as AI smartphone premium tier demand drove Gorilla Glass ceramic adoption, now standard on 60% of premium flagships by unit volume.
Environmental Technologies, $255 million. Auto emission control substrates, flat year-over-year as global auto production held steady. This segment is a modest and stable contributor, not a growth driver.
Life Sciences, $550 million. Pharmaceutical and laboratory glass grew 8% year-over-year from GLP-1 vial demand. Eli Lilly and Novo Nordisk are Corning's largest life sciences customers by vial volume.
Adjusted EPS, 57 cents. The 52-cent estimate implies earnings leverage on revenue upside. GAAP EPS was 42 cents, reflecting amortization from prior acquisitions and restructuring charges. The GAAP-adjusted gap narrows as restructuring charges wind down in 2026.
Operating income, $630 million, 15% operating margin, up from 12.9% in Q1 2025 on the same revenue base. Fixed cost leverage on optical volume. Corning's fiber plants run at higher margins above 80% capacity utilization.
Free cash flow, $450 million in Q1, constrained by the elevated capital investment in optical fiber expansion. Capital expenditures were $400 million in Q1, highest since the 2020 fiber buildout. Full-year capex guidance, $1.4 billion.
Balance sheet, cash $1.53 billion, total debt $10.2 billion, net debt $8.7 billion. Debt to EBITDA approximately 4.2 times, elevated but declining as EBITDA grows. Investment-grade credit rating maintained at BA2.
Dividend, 60 cents annually, 15 cents per quarter. At 169, yield is 0.4%. Corning raised the dividend 2% in Q1 2026, the 15th consecutive annual increase. The payout ratio is moderate at 30% of adjusted earnings.
Full year 2026 guidance. Revenue of $17.5 to $18 billion, 12 to 15% growth on FY 2025's $15.6 billion. Adjusted EPS guidance, 2.35 to 2.55. The guidance implies accelerating optical growth and margin expansion.
Wendell Weeks has been CEO since April 2005, one of the longest tenures among S&P 500 leaders. He has navigated Corning through the fiber optic bust of 2001, the smartphone glass transition, and now the AI data center fiber buildout.
Week's Q1 message. The fiber optic demand surge is structural, not cyclical. AI training requires 100 times more fiber per compute unit than traditional cloud. He targets doubling optical revenue by 2028.
The Springboard plan, launched in 2024, targets $400 million in annual cost savings through manufacturing consolidation. The North Carolina optical fiber plant is the offensive move, adding capacity while lowering unit costs for the AI buildout.
Innovation pipeline. Corning's next-generation Edge AI glass, an ultra-thin substrate for on-device AI chip packaging, is in joint development with two top 5 semiconductor manufacturers. Commercial production is targeted for late 2027.
Revenue bridge, 22% growth from $3.45 billion to $4.2 billion. Optical Communications contributed 70% of the incremental revenue, $530 million of the $750 million total increase.
Gross margin bridge. Gross margin expanded from 35 to 38%. Fixed cost leverage contributed 2 points. Optical plants above 80% utilization absorb incremental volume with near zero marginal cost. Mix shift to higher margin optical contributed 1 point.
SG&A, $400 million in Q1, 9.5% of revenue, down from 11% in Q1 2025. The Springboard savings are appearing in the SG&A line. Headcount reductions and facility consolidations are delivering as guided.
EBITDA $850 million in Q1, annualizing to $3.4 billion. At $146 billion enterprise value, market cap $146 plus net debt $8.7. EV to EBITDA is approximately 14.3 times.
Interest expense, $118 million in Q1, annualizing to $470 million. Net debt of $8.7 billion at blended cost of approximately 5.4%, elevated but manageable as EBITDA grows and interest coverage improves.
Capital expenditure, $400 million in Q1, driven by the North Carolina optical fiber plant and optical connector capacity expansion. Corning is investing aggressively for 2027 and beyond when AI buildout reaches peak fiber demand.
FCF bridge 850 minus capex 400 minus interest 119 minus taxes 90 equals approximately FCF of 240 adjusted for working capital. Full-year FCF guidance of 1.8 to 2 billion is achievable at current growth rates.
Optical Communications margin. This segment runs at approximately 22% operating margin at current volume, up from 17% 18 months ago. As the North Carolina plant comes online in 2027, incremental optical fiber costs decline, pushing margins toward 25%.
Display Technologies profitability. Display glass generates approximately 12 to 13% operating margin, steady but not growing. Volume is stable, pricing is stable, and the segment funds corporate overhead while optical grows.
Tax rate 17% adjusted, benefiting from R&D tax credits on optical communications innovation and U.S. manufacturing investment credits under the CHIPS Act. The effective rate is structurally lower than peers due to the intensity of U.S. capital investment.
Working capital. Corning's receivable days are typically 60 to 70. Hyperscaler customers pay on net 60 terms. As optical volume grows, receivables expand before collections normalize. Q1 working capital consumed approximately $150 million in cash.
Leverage trajectory. Net debt $8.7 billion at Q1 versus $9.2 billion at year-end 2025. Corning is deleveraging. EBITDA growth is outpacing debt paydown. Target leverage of 3 times EBITDA is achievable by 2027 at current growth.
Prysmian comparison. Prysmian, the Italian cable manufacturer, is Corning's closest public fiber peer. Prysmian trades at 22 times EBITDA versus Corning at 14. Prysmian's higher multiple reflects its integrated cable and glass model.
Lumentum comparison. Lumentum, optical component maker for data centers, trades at 28 times forward earnings. Unlike Corning's commodity fiber business, Lumentum makes higher value transceivers and modules. The comparison shows GLW's valuation discount to optical peers.
Applied Materials comparison. AMAT supplies semiconductor equipment, also a picks and shovels AI infrastructure play. AMAT trades at 22 times earnings versus GLW at 16 times. GLW's lower multiple reflects lower perceived AI leverage compared to semiconductor equipment.
Samsung Display and LG Display, Korean panel makers, are Corning's largest display glass customers. As they invest in OLED and high refresh rate gaming displays for AI-capable devices, Corning's display glass volume and pricing stabilize.
Telecom fiber peers. CommScope, Belden, and Prysmian compete in cable assembly but lack Corning's integrated glass-to-connector manufacturing. Corning's vertical integration from silica to finished connector is a cost and quality advantage.
Market structure. Corning holds approximately 35% of the global fiber optic cable market, a natural oligopoly with Prysmian, Sumitomo Electric, and Furukawa. No new entrant has built a competing optical fiber plant since 2002.
Valuation context. GLW at 12 times trailing EBITDA is below its pre-fiber surge level of 16 times. If the optical buildout is a 3 to 5 year cycle rather than a 1 to 2 year burst, the current multiple implies significant compression risk if orders plateau.
Risk 1. AI capex cycle pause. Hyperscaler fiber orders are front-loaded. Companies are ordering 18 months in advance to secure supply. If AI model training plateaus or investment pauses, as Microsoft indicated in Q1 2026, fiber orders could slow before Corning's North Carolina plant is online.
Risk 2. China competition in display glass. China's BOE technology is investing in indigenous display glass manufacturing, reducing dependence on Corning for LCD substrates. If BOE's glass reaches commercial quality, Corning's display glass share in China could decline from 70 to 50%.
Risk 3. Leverage. Net debt $8.7 billion at 4.2 times EBITDA is elevated for a cyclical manufacturer. If optical fiber orders slow and revenue drops, EBITDA compression could push leverage above 5 times, near a credit watch threshold.
Risk 4. Fiber price deflation. As 3 new fiber manufacturing plants from Prysmian, Sumitomo, and Corning itself come online in 2027-2028, fiber pricing could decline. Corning's margins depend on fiber prices staying above their current 4-year high.
Catalyst 1. Hyperscaler order acceleration. Alphabet, Microsoft, and Amazon guide significant data center capex in their Q1 2026 calls. If any of the three announces an AI infrastructure spending increase, GLW optical fiber backlog extends beyond 2027.
Catalyst 2. Edge AI glass design win. If Corning announces a commercial design win for its Edge AI chip packaging glass with a top 5 semiconductor manufacturer, the TAM for this product expands GLW's addressable opportunity beyond fiber.
Catalyst 3. Display glass pricing inflection. If Korean panel makers announce capacity expansions for OLED gaming monitors and AI-capable displays, display glass pricing moves from flat to positive for the first time since 2021.
Analyst Consensus 18 buy, 7 hold, 0 sell. Average price target 190, 12% upside from 169. The analyst community is broadly constructive on GLW's position as the dominant optical fiber manufacturer in the AI buildout cycle.
BAFA buy at 210. The optical fiber order book, extending to 18 months, is unprecedented in Corning's history. BAFA models optical revenue of $8 billion by 2028, double 2024 levels, on AI data center fiber demand. At 12 times EBITDA, fair value is 210 to 220.
Citigroup buy at 195. The springboard cost savings are flowing through faster than modeled. Gross margin reaching 40% by year-end would add approximately $100 million in annual operating income at current revenue, a 15-cent EPS impact.
Morgan Stanley equal weight at 165. The fiber optic cycle is well understood by the market and priced in. GLW's 340% rally from the 52-week low has pulled forward 3 years of earnings growth. The risk-reward is balanced.
FCF yield case. At full-year guidance of 1.8 to 2 billion FCF, the FCF yield on 146 billion market cap is 1.2 to 1.4%. Low yield for a cyclical company, the stock is pricing in sustained growth, not a peak cycle.
The FY 2026 adjusted EPS guidance of 2.35 to 2.55 implies 17% earnings growth. At 16 times forward earnings, the implied fair value is 152 to 164 on a post-split adjusted basis.
At 169, GLW trades at 16.3 times the midpoint of guidance, above the historical range of 12 to 14 times. The premium reflects the AI fiber narrative premium. It holds if optical orders accelerate, reverses if orders plateau.
Bull case, optical fiber is not a commodity cycle. It is structural infrastructure. Every AI token generated requires fiber. Every GPU cluster connects through fiber. As AI model compute doubles annually, fiber demand compounds. Corning's monopoly position means it captures the majority of that demand growth.
Edge AI glass optionality. If Corning's Edge AI glass becomes the standard substrate for on-device AI chip packaging, the total addressable market for this product exceeds $10 billion annually, 3 times larger than the entire current optical communications segment.
Margin expansion compounding from 32% gross margin in 2023 to 38% in Q1 2026 to a targeted 40% by year-end. Each margin point on $4 billion plus quarterly revenue adds $40 million in gross profit, compounding as scale increases.
Bear case. Hyperscaler fiber orders are pulled forward demand, not incremental. Microsoft announced in March 2026 that it was reviewing AI infrastructure spending, a signal that the front-loaded fiber procurement phase may be ending. Orders could normalize before the North Carolina plant even opens.
Display glass secular decline. OLED technology is replacing LCD panels, and OLED panels use less glass. As the transition accelerates, Corning's $1 billion quarterly display glass segment faces structural volume pressure, not just pricing pressure.
Leverage bear at 4.2 times EBITDA, Corning has limited balance sheet flexibility. A recession or AI capex pause simultaneously compresses EBITDA while the capex for North Carolina continues. Leverage spikes toward 5 times and dividend sustainability is questioned.
Resolution: bull case wins if AI infrastructure spending sustains at $200+ billion annually through 2028 and Corning maintains its fiber share. Bear case wins if hyperscalers slow capex. At 169, the stock price is in continued acceleration. Q2 guidance is the next verdict.
Bottom line on Corning. Q1 2026 confirmed the AI fiber thesis. Optical Communications at $1.85 billion is growing 41% year over year, and the order backlog is 18 months. Springboard cost savings are flowing to margin. The stock's 340% rally from its low reflects a legitimate structural shift in Corning's earnings power, but the current multiple prices in sustained execution.
18 buy, 7 hold, 0 sell. Average target 190, 12% upside from 169. The bull case is AI fiber structural demand. The bear case is hyperscaler capex pause. Q2 guidance for optical orders is the deciding data point. The dividends have grown 15 consecutive years.
Charged Alpha is an educational commentary podcast. None of the content here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. We do not hold positions in securities discussed on this show. Always consult a licensed financial advisor before making any investment decisions. Securities mentioned are for educational discussion only and are not buy or sell recommendations.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.